What's driving the market this week? The Fed will speak Wednesday, the 31st. Big tech earnings, the Magnificent Seven will be releasing earnings this week, next week. And what will the jobs report look like? The Fed is expected to speak on the 31st, probably around 11 o'clock Pacific time, giving us some type of decision. Probably say nothing, to be honest. I don't know what he would have to say other than the fact that they're going to wait to see what happens with inflation for the next couple months. The market's up, priced in rate cuts already for March. I don't really see that happening though. If the employment situation is still strong, there's really no need to cut rates. There's no urgency on the Fed to have to cut rates. And we've got two more CPI reports due before he makes any decisions in March. So there's February 13th and March 12th, and then the Fed will probably talk after that as far as whether or not they're actually going to cut rates. I don't really see it because if you look at the market here, when the market was doing the best is when the inflation was down, and in 2021 was our first sign of inflation at 4.2%. It's most significant jump, and really ever since then everything is revolved around what's happening with inflation. It has gone up 2021, all of 2022, and then right around here in 2023 it dropped to 3%, and that's when the market started rising on the lower interest rates. It's all been 3% something, but honestly the Fed has continued to talk about getting to 2%. And to me, this seems like the wrong direction. 3.2, 3.1, 3.4. We need to get to 2.9, 2.8, something like that. But this is a 3% drop. This is when the market actually started going up, thinking that maybe it's going to get under 2% or under 3%. And I hear a lot of talk about, oh, inflation's down, inflation's down. Inflation's not down, it's up. It's up more than actually it's ever been. If you look before the 4.2, we don't see inflation up at 3%. All those years, we haven't had more than a 3% rate of inflation. So it's slowed down from the previous years. Yes, it's not down. Let's just take a quick example here of what the inflation did back in 2021. It hit at 5.4%. So looking at the chart, in 2021 it was 5.4%, 9.1%, 3%. So based on that, if you had $1,000 and inflation jumped from 2020 to 2021 at a rate of 5.4%, that's a $54 increase on your $1,000. So every $1,000 you had, you now need $1,054 to have the same buying power. So in 2021, this is 1,054, and then the next year it went up another 9% on top of the 1,054, which is a $95 increase, $96 increase, taking up to 1149. And then in 2022, the best year it had, or the lowest drop we've had is 3%. It's a $34 increase on top of that. It takes you to almost $1,200. So let's say we get 2% this year, 2024. If you get 2%, that's $23 jump. That means in 2024 you'll need $1,200 to match what you could buy for $1,000. So $10,000, you need $12,000. So take your salary and multiply that out to see what you get. And that's if everything's good. Everybody's thinking, oh, 2% is good. Wait a minute, what about these? We need to get these back down. You need a negative number to go back down. And what if it's 3%? If I change this to 3%, that changes this up here to 1,200. If I change this back to what the Fed is hoping for, which is 2%, you're still looking at a 21% jump in the increase of inflation since since 2020. So Whatever you had in 2020, you now need 20% more. Are you making 20% more for every $1,000 you were making? Are you making 21% more than you were back in 2020? That's what you would need just to have the same amount of money that you had back in 2020. Okay, so we need, if you even got a minus 1% drop, you're still at a 17% from what we were. And if we have a negative number, everybody's going to panic. Oh, we're having deflation, deflation. Like, we're not really having deflation because we had 5%, 9%, and 3%, which was way high from compared to the previous 10, 15 years. So even at a minus 10%, you're still looking at 6% more than what you had in 2020. You would have to get like a negative 15% to get back to even money. There's no way you're going to see a negative 15%. So again, a lot of people are saying, well, if inflation has gone down, how come the prices are still so high? The prices are still so high because it's gone up since the prices have gone up. It just keeps going up and up and up. 3% is just a lower number than the last year at 9%. Yes, it's a lower number, but it still went up 3% from what the 9% was. So I don't see why the Fed would feel any pressure to make any cuts because the market is up and the employment situation is up. He doesn't have to cut rates. So I don't honestly see him raising rates is helping the market. It was supposed to create less employment and drive prices down. Prices haven't gone down. They are up, even though they're not up as much. And employment situation has remained strong the entire time he's been raising rates. So I don't agree with the fact that he's raising rates. It has done nothing to do what he said it would do.